Hello everyone, welcome back to our channel where I discuss my holdings and track my investments. Today, I'll be discussing an important topic: dividend investing into ETFs versus dividend stocks. Now, I do have some ETFs here, for example, and here are several other popular dividend ETFs. And here is a list of many popular dividend stocks. So maybe you already hold some of the ETFs that I've shown or some of the stocks that I just showed. And I just want to get into which is better, holding ETFs or stocks. So first, for the new investors, what is an ETF? An ETF is simply a basket of stocks. So dividend ETFs like this hold a basket of dividend stocks. Now, dividend ETFs come in two different varieties. There's ETFs that are more dividend growth centric, such as VIG or the Vanguard Dividend Appreciation ETF, and there are dividend ETFs that are more yield-centric, such as the Invesco S&P 500 High Dividend Low Volatility ETF. So in the case of dividend appreciation ETFs or dividend growth ETFs, generally they'll have a lower beginning yield, but these types of ETFs will have a much better growth rate over time, year over year. So this is a list of dividend payments by the ETF VIG from Vanguard that I just showed, and what you'll see is generally in this column, these dividend payments will increase over time. So that's kind of the hallmark of these ETFs, increasing dividend payments year over year. And the other type of dividend ETFs I like to call the yield ETFs. They provide a high current yield but not much room for appreciation down the line. So you see that its 5-year average growth rate is much less than VIG. And if we look at this history here on this column, you'll see that the dividend growth is pretty stagnant over time. There isn't a lot of growth, and in fact, sometimes it decreases. So what does that mean? Well, generally speaking, if you want high income today, you would go with the yield ETFs. And if you have plenty of room to allow your investment to grow, it would be a better idea generally to go with the dividend appreciation ETFs. Overall, however, there are some key advantages of investing in all dividend ETFs, whether they be an ETF that focuses on yield or on growth. So the most key benefit is that it is a diversified holding and asset. So you see here VIG's holdings. These are the top 10 holdings. You see Microsoft, Apple, United Healthcare, and so on and so forth. So these are basically diversified assets that you don't have to concentrate on. They're diversified in themselves. And here is a small sample size from SPHD. You see, again, MO, which is Altria, Verizon, and Kinder Morgan, and then so on and so forth. So if you're looking for dividend ETFs or maybe at dividend stocks and you're new and you kind of have anxiety over picking stocks and deciding which stock would be good, I would say that a dividend ETF would be a great choice, as you don't have to really consider whether a stock will perform well or not. These ETFs kind of do that for you. They place a basket of dividend stocks in these ETFs, and you're kind of diversified in the overall market based on whether or not they choose a metric. So basically, like Vanguard will choose a bunch of stocks that have appreciating dividends, such as these. So Microsoft has appreciating dividends, Apple, and all the other companies have appreciating dividends because the selection method on the ETF is to screen for companies that grow their dividends over time. Whereas the selection method for the fund SPHD focuses on high yield stocks and another one which is low volatility, but that's a separate issue in itself. So basically, the ETF kind of selects the top 50 stocks in the S&P 500 that pay the highest dividend and then invests in that. And I kind of want to highlight how good that is for a new investor. Like even me, I have been investing for probably about 7 years now, and I still only exclusively hold ETFs. I have picked individual stocks before, but there's basically too much back and forth and anxiety. Oh, is this stock going to do well? Is it going to do bad? Is it going to increase its dividend? Is it going to decrease its dividend? What's the CEO saying? there's just a lot of noise when it comes to stocks, and I decided that at least until I get my first $100,000 invested, I am not going to touch stocks because I want a strong foundation before that. And going back to the anxiety of picking and choosing stocks, with the ETFs, you don't have to do that. There's ETFs that are passively managed. In this case, the Vanguard Dividend Appreciation ETF is passively managed, and SPHD is also passively managed. So you have basically these fund managers setting these parameters on these ETFs, and the ETF will just track the performance, and you don't have to worry about whether an individual stock does poorly or badly. If it doesn't meet the criteria, the stock will drop out, and you don't even have to worry about that. So with SPHD, it's kind of similar. It's composed of 50 securities traded on the S&P 500 index that historically have provided high dividend yields and low volatility. So you don't even have to look for the stocks with the highest dividends. This fund will do it for you, and you don't even have to worry. If a stock drops out of that screening metric, then the ETF will remove that stock, and you don't have to worry about doing it at all. So the professional management aspect of these ETFs are a wonderful thing, and it takes away the anxiety of new and even experienced investors from picking and choosing individual companies. So with that said, why do people choose stocks then? So kind of going back to this list, you see a huge list of all of these stocks, and it can kind of be a form of information inundation for any investor almost. And I kind of got caught up in the information inundation when I was picking and choosing stocks to begin with, because I would say, okay, I want this stock, I want that stock, I'm going to get this stock. And what you see when you choose a bunch of stock, we're talking over 15 to 20 plus, you basically perform just as well had you have invested in a dividend ETF to begin with, because all the diversification kind of leads to a generalized, appreciation. So if I were to go to that list that I just showed you and try to pick a bunch of different dividend stocks with yield, if you notice the weighting of this probably comprises over 30% to begin with. So eventually, all of my stocks that I would pick would eventually track an ETF or come very close to it. And that kind of defeats the purpose of picking individual stocks. And the purpose of individual stocks would be to outperform an ETF. And there's another popular YouTuber that started their YouTube channel several years ago, and this is their first video. It's Joseph Carlson. He has about 268,000 subscribers now. So from that video, I basically tracked down his Reddit post from when he first started investing. And what you'll find out is that he originally was invested in quite a few stocks. So it looks like there's probably around 30 or so stocks here. So on his most recent videos several years later, you can actually bring up his current portfolio. And now what you'll see is after years of experience of investing, the years that he had, his yield firstly dropped. It went down. He chose more dividend growth companies rather than dividend yield companies. And you'll see he is actually a lot more concentrated with just 14 holdings. And one of those holdings even is an ETF. The one that I have, the Schwab US Dividend ETF, solid choice. But you basically see him with all of his experience, he actually got more concentrated, and his dividend yield dropped, because I guess what he realized was the same thing that I was just explaining. When you choose a bunch of dividend companies to invest in, you wind up performing in line with the index. So what I suppose he did was he realized this as well and went more concentrated on quality rather than quantity. So he basically tries to, at this point, pick the best of the best, instead of what he was doing before, which was picking just a wide variety of companies that basically didn't seem to have any direction. Like some of them had rather high yields here. One of these companies had a 7% yield. We have another company, 5.2% yield, and he just exited out of all of those companies or quite a few of them and just pick the best of the best instead. And I guess that's how he arrived at his current portfolio over time. He probably just didn't want to manage too much, and he realized that over diversification was limiting his growth, or the benefit that you get from picking individual stocks. So for like the new investors, a stock is simply a part ownership of a company. If you just basically buy a share of this company, Broadcom, you are basically entitled kind of to a vote. I'm not sure if this is one of those companies that require you owning a certain number of shares before you vote, but generally that is the idea. You invest into a stock and you are a part owner of their company, and you could demand that the board, provided that you own enough shares, do something. So kind of like the benefit of owning a stock is that you can pick the best of the best, and there's no need for any of the companies that may not perform as well. So at least in the case of VIG, I kind of brought up the 5th page, and there are probably some holdings as we go further down that aren't necessarily the best of the best. They will perform worse over time, and what you will see with some ETFs and overcomplicated stock portfolios is diversification becomes diversification because you're picking so many stocks. Some of them will underperform. So in the case of this stock Broadcom, you see if you would have invested in this company 1 year ago, you would have seen a return on your money of about 67%, and you would have got about a 2% yield, give or take, during that time. And now looking at the dividend appreciation ETF VIG, you see that you would have performed pretty well overall, about 13.5%, but you still would have underperformed Broadcom by a wide margin. And the same thing is true with Microsoft. Had you have invested in Microsoft, you would have got a growing yield, and you would have seen about 31% return on your money, whereas VIG just returned again 13.5%. So this kind of highlights the difficulty of picking stocks. Kroger is a great company. It operates as a grocery store, many locations across the United States, pays a pretty decent yield. But had you have invested in it instead of VIG, you would have far underperformed VIG. And you kind of see the same thing with other companies. Although CSX did beat VIG by about 1%, you also have to kind of like decide whether it's worth your time to look for companies like CSX, or let's see if we can bring up Waste Management too. It kind of performed in line with VIG too. So had you have held these stocks and you picked them, you would have found out that you barely performed better than VIG, and you would have basically took the time and maybe even wasted time to barely outperform a diversified ETF. So basically, when it comes to individual stock selection, it comes down to if you can pick companies like this and avoid the companies that decrease in value. Otherwise, you are going to either perform in line with an ETF, or you are going to underperform the ETF, and it would make the whole thing pointless. So to answer the initial question of the video, I guess when it comes down to it, the kind of like determination of whether you should pick a dividend ETF or a dividend stock comes down to your comfortability of picking the stocks that outperform. And for me personally, I don't feel comfortable picking the stocks that outperform. So I just decide to just choose some diversified ETFs and go from there. And I think to highlight this point one final time, we see that Warren Buffett kind of had a bet of whether you should just choose a diversified index fund or go with a fund manager that picks stocks specifically. So these fund managers who are experts in stock picking, they have 8-hour days where they could just choose stocks, actually underperform the S&P 500. So I personally don't know if I would be able to consistently outperform the S&P 500 while these fund managers can't. So everyone, that is going to be it for today's video. I really do appreciate you watching. If you're still here, please leave a like for the video if you did enjoy it, and perhaps subscribe if you'd like to see future updates. Thank you all and have a good day.